backed and powered by 150 years of business experience. Venue is a virtual data room trusted by the best of the Fortune 500 to move deals seamlessly from one to the other to the next too.
Just last week, the M&A market and media was thrown for a loop when Comcast's purchase of Time Warner Cable was rejected, and we're still awaiting the verdict for AT&T's buyout of DirecTV. These mega mergers would have given or will give the pay TV network operators much greater clout in their negotiations with content producers and more scale to develop online services. A wave of consolidations among content creators has not yet materialized, though Fox made a brief unsolicited bid for Time Warner last year. And the demarcations between media and technology continue to blur. Traditional media group Disney acquired YouTube channel operator Maker Studios, while social network LinkedIn has acquired educational video producer lynda.com. Tech groups are also looking for media to expand their ecosystems, as Amazon.com's purchase of video game streaming company Twitch TV reflects. Against this changing strategic backdrop within media and entertainment, we are now going to examine deal-making valuations and finance. Welcome to today's third installment of Merger Talk. My name is Mark Aiello, Vice President and General Manager for Venue, the virtual data room of R.R. Donnelley. Today I'm joined by Glenn Schiffman, Senior Managing Director at Guggenheim Partners. Glenn is a veteran investment banker with over 2 decades of advisory, capital markets, and investing experience. Glenn was Global Head of Media at Lehman Brothers, ran Asia for Lehman and Nomura, and was CEO of Nomura's broker-dealer in the US when he headed Nomura's investment bank in the Americas. Glenn also had experience at a merchant bank, so he brings a terrific perspective to our discussion. Glenn, thanks for joining.
Thank you.
Thanks. So the first question that I have is, when you think about media and entertainment, what are the current multiples and where do you think they're headed?
So I think when you think about media and entertainment, it's a very diverse group of companies in a very diverse sector, and the multiples are clearly very wide and broad. You know, gone are the days when all of the companies traded in a specific cluster and different sectors followed very similar patterns. So I think we're beginning to see companies and assets being valued very differently by the marketplace. Content and distribution are clearly evolving, as you remarked in your opening statement. Business models are changing, small bundles. You're hearing a lot of talk and action around small bundles, the rise of over-the-top. Digital content is becoming much more prevailing and widespread in terms of its distribution and its use. Advertising is shifting online to a significant degree, programmatic advertising. So there's a lot that's going on in the ecosystem for sure. It's a confusing time for many, and investors and buyers are looking at different companies differently, rewarding certain strategies, rewarding certain assets. You know, it used to be a lot of investors, if media companies went below 10 times, you would buy. They went above 10 times, you would sell, and the market would give you that opportunity and take that opportunity from you over time. Again, it's a lot different now. You know, content companies for a long period of time traded at a significant premium to distribution companies, but now we're having some distribution companies, given their strategy and given some of their operating results, are trading through some of the content companies who investors believe in this marketplace may not have the right strategy to be successful long term and may not have the right ability with their assets and again their strategy to prosper in this evolving and changing and complicated world.
So you mentioned business models being changed and valuations being questioned. Are those factors what's driving M&A?
You know, that's part of it for sure. You know, we look at M&A not as a strategy in and of itself. M&A is a way to accelerate a strategy, enhance a strategy. So yes, people are looking at M&A offensively to take market share, to capture growth, to secure distribution, to diversify content. People are also looking at M&A defensively to protect market share. A hedge against this changing consumer behavior, a hedge against the uncertain world, programmatic advertising, for example, a hedge against dollars shifting online, and again, the changes in consumer behavior that are happening, as we know, we all have kids, that are happening radically and very quickly. So M&A, yes, of course, has a lot to do with that. Again, offensively and defensively, but importantly and critically, does an M&A transaction make strategic sense?
So what's the overall tone of the marketplace? Do you expect to see consolidations accelerate?
Yeah, the tone is quite robust. Is quite robust. I was out at the Milton conference last week, and I forget who said this on some panel, but 56% of CEOs on the Fortune 500 said they intend or are trying to do an M&A deal within the next 12 months. So the environment is quite strong. Currencies, stock prices are robust. The mood is robust. CEO confidence and board confidence is there. So yes, there are a lot of discussions, but it's a complicated time in terms of how to navigate it. Yes, I think M&A will be a component of how companies navigate this new landscape in media, both offensively and defensively. I contrast that to a couple of years ago. Boards are saying, why not? Let's do something. Why aren't we doing something? Years ago, 2009, 2010, boards were saying, why are we thinking about doing something? The other dynamic that's come to play, obviously, as we all know, in the last couple of years, is the rise of the activist investor and shareholder. So that also plays a role here.
And are you seeing fundamental differences in the activity of financial acquirers versus strategic acquirers?
Yeah, a lot's been written about, given where we are in the marketplace, that the financial acquirers have not been as busy. LBOs, straight go privates are down, vis-a-vis a percentage of total M&A volume. That's as a result of valuations. Valuations are high. That's one. And two, the strategics, as I said, the strategics are very active in the M&A market. And strategics, with certain synergies and a currency that's well valued, can pay more in an auction or more in a transaction. And what we're also seeing, which is different, is acquirers' stock oftentimes goes up on announcement, which is a very different dynamic. So again, that gets back to your earlier question of helping drive the M&A market and confidence around a transaction. So despite leverage levels and the leverage markets being quite constructive, we're just seeing more strategic acquirers than financial acquirers in the marketplace. And you've seen some of the financial players shift their strategy to some growth-oriented, non-control investments. Money goes to where it's needed and stays where it's rewarded. So you're seeing that dynamic take hold.
And last question, Glenn, how are you seeing deals being structured these days versus pre-financial crisis?
Yeah, I just mentioned earlier that the financial markets, the high yield and debt markets are quite strong, are quite receptive. That said, we are not near the leverage levels that we saw in 2007, 2008. Debt to EBITDA is off. I think I saw some chart where at the peak, the average debt to EBITDA multiple was 6.2 or 6.3. I think the average in the last quarter is something like 5.6. And then equity as a percentage of overall purchase price equally is higher than it was. So they're being structured when financial deals happen more conservatively, and corporates are also using stock to a significant degree, and more so than we've seen in a little bit. I guess on the flip side, we're seeing a ton of buyback and buyback activity and dividend payments, more than before. So I don't know where those lines cross, but we are seeing deals with more equity than debt versus 2007, 2008, right before the financial crisis.
Glenn, thank you so much for your time today.
Thank you.
And thanks for joining. For more merger talk, visit thedeal.com.